Well, good morning then, everyone, on Wednesday, the 19th of July. Now, we had a bit of time to digest the UK inflation figures this morning, which is the reason why this video is slightly later today. Um, you can see across the headlines, stocks climb, sterling weighed down as UK inflation slows. Now, we'll get around to the calendar in a minute. We'll have a look. Sterling across the board has sold off heavily this morning, and the FTSE is rallying off the back of it. Now, expectations then for interest rates not to rise as high as markets had initially thought has caused massive upside in the FTSE, massive downside in bond yields, and massive downside then in the currency. So the expected reaction to what you would expect to see from say a dovish central bank. Now, obviously, a lot is priced into markets at the moment in terms of interest rate hikes, and certainly in terms of sterling. Sterling has got the highest net long positioning since Brexit kicked off. So there's a lot of positions to unwind in sterling, and if this trend in the inflation figures continues lower, then there is a lot of long positions to be closed out in terms of the price of sterling. So we've had some substantial downside over the course of this morning, but you have to imagine that probably continues at least for the rest of the week, possibly into next week as well. Certainly in the short term. Now, in terms of what that means kind of going forward for other markets across the board, that is something that is confined to the UK. So we have not seen reaction across the board as you may see with, say, the Fed. So keep an eye on those sterling related assets, or should I say UK related assets, going forward. But you can see Eurozone bond yields continue to slide after UK inflation slows. So it's something that can feed over into other markets, but I wouldn't focus on other markets. You'll see some of the headlines kind of using something to kind of suit the narrative, but we'll have a jump across some charts in a minute. But really, UK related assets is where you need to focus on. This is something that is confined to the UK. So the inflation situation in the UK is different to the rest of the world, or certainly across the rest of the G8. Inflation had been continuing to rise, but certainly in terms of all metrics of inflation, we've had lower than anticipated prints today. So you'd have to imagine this morning the Bank of England's governor, Andrew Bailey, is breathing a sigh of relief. In other news, the Japanese yen, the Bank of Japan's governor, has come out with some comments that he's going to stick to mixing up my words, he's going to stick to ultra loose monetary policy moving forward, which has caused a bit of a bounce back in the Japanese yen in the opposite direction. Couple that with the aggressive rally in the US session yesterday, makes a little bit of sense for a pullback in the price of the Japanese yen, which will come back here, and you can see the Japanese yen mainly negative across the board, in line with those sterling, the prices of sterling, as you can see here. Sterling lower across the board. You can see the FTSE as you come over here up 1.3%. So the expected reaction to that, but you can see a bit of positivity then feeding across into other stock markets. But as I said, really it is confined to the UK. You can see US stock indexes basically flat, albeit slightly positive, and you can see European equity futures higher across the board, but the FTSE is the outlier, up 1.3%, nothing else above 0.5. Asia Pacific equity futures relatively mixed, commodities relatively mixed. You can see bond yields lower across the board. UK yields potentially driving global bond yields slightly lower, but the biggest move is obviously in the price of UK bonds. Obviously, gilts being purchased and the yield then moving lower. In terms of the UK bonds, you'd have to imagine that going forward that the long end of the curve will should steepen and begin to more normalize, rather than the short end of the curve being in focus. So we'll keep an eye on that in terms of UK bonds moving forward. In terms of the US dollar, strength across the board in the US dollar to start the trading day. As you can see, there's obviously been a lot of negativity over the course of this month in terms of the dollar, but the bounce back continues, which is what we had expected on Monday heading into this week. Apart from that, FX across the board is relatively mixed as we come across to some charts, and we'll have a quick look. But let's start with the calendar, and you can see these UK inflation figures. The headline figure, previous 8.7, consensus 8.2, down the actual 7.9%. But there's a long way to go in terms of getting inflation under control back to the Bank of England's target rate of 2%. It is still 4 times above that. So certainly not out of the woods yet, but it is a step in the right direction for the UK economy. The core CPI print as well, consensus was for it to be unchanged. Actually, it did pushed lower by 0.2%. So the total rate of inflation plus the core rate of inflation both pushing lower, lending a bit of support to the UK stock market in hopes that the central bank will not hike interest rates to the point where they initially thought. Inflation, in terms of the month-over-month figure, the CPI month-over-month figure, consensus 0.4, actual 0.1, showing basically no growth over the month of June. Still slightly positive. You probably want that to turn negative in order to really get prices back down to a more normal rate. This year-over-year figure still is 7.9% higher than the previous year. You can see 10.1% back here. So this is still 8% higher than the 10.1%. You bring it out a bit longer, it's 8% higher, even slightly higher than the 10.1, probably 11 actually. Once you take into consideration it was actually June, obviously, that we're looking at rather than July. So still 8% higher than that 10% that was back in June. Mid kind of 2021, you're still up nearly kind of 5.5%, 6%. So 8% higher than that 11%, which was 11% higher than that 6%. So it's a bit of a it's kind of, obviously from a markets perspective, speaking about markets and trading about markets, you understand these figures, and 8% higher than the 11%, which the 11% is higher than the 6%. It's still over 20% inflation in the course of 2 years. So that's what a lot of people will fail to understand. The likes of the news sources, your BBCs and the likes, will be like, oh, great progress made on inflation, but in reality prices are still 20% higher than they were 2 years ago. So, and that is cumulative as well, so it's probably more like 25% higher. So it's a bit of a mess. Markets have taken it as a positive this morning, that inflation missing on consensus, but in reality, does it fix anything in terms of prices for people? Absolutely not. So from a humanitarian point of view, from a cost of living crisis point of view, absolutely no benefit to anybody's lives. But from a market's point of view, inflation coming down, interest rates likely to not be raised as much as markets have priced in. Some market participants even expecting up towards 7.5%. So bets for that have ramped down over the course of this morning, and that has caused some massive downside in the price of sterling as well. Obviously, you can see the big 1 hour candlestick, as you can see here, but it also has continued lower over the course of this morning. It will be interesting to see how price reacts to these lows that we are currently at now. Do we continue on and break through these lows and have another leg lower? That certainly would be interesting. There's a lot of long positioning to be unwinded in the price of sterling. You flick this across to a daily chart, you can see since the lows posted after that Liz Truss and Kwasi Kwarteng situation back then, it's just been a one-way train since then, especially such aggressive moves over the course of July so far into this week. Then you'd have to imagine this at least gets back to somewhere around 26. So there's a fair bit of room to go in terms of downside, in my opinion, in sterling over the coming days and next week or two. So something definitely worth keeping an eye on. Try and make a bit of cash for yourself in the coming days ahead. You can see dollar yen continues its bounce back. It's failed to create new lows a couple of times, and now it is pushing higher. Not a lot of resistance levels up to kind of target. Maybe this level at 141. You can see these highs back here. Maybe that's a decent port of call. But 140 normally at a figure that acts as a bit of support and resistance in the past. And dollar yen, probably the first thing I keep an eye on. But certainly a bounce back in the dollar yen is not unsurprising. You can see UK stocks going through the roof. The FTSE, up 1.3%, as we said. Obviously since that since the release at 7 o'clock, it's just been a one-way train, and that looks probably set to continue higher. You're back testing these highs at the moment, so that's what I would keep an eye on initially, that 75.60 level. If you can break that, probably looks prime for a test up here around 76.50. So keep an eye on the FTSE as you head towards into today's European session, or into today's US session, should I say? Sorry, but US markets likely to take over as we get into US trading later on today. So something worth keeping an eye on. FTSE as well. If US stock indexes can continue their move higher, that should prove supportive for the FTSE as well. But you can see UK bond yields then driving slightly lower bond yields across the board, but really these UK yields, you'd have to imagine they more normalize off the back of interest rates to not rise further. It's been a one-way train across these for a number of months. Now you can see they've got a lot of room to give back. If that continues lower, that should be further negative for sterling and positive for the FTSE, as that is a situation, or that is a move driven by interest rates and not expectations around growth in the economy, although growth is not great in UK at the moment. Those bond yields moving off the back of interest rates is a reason for sterling downside and FTSE upside. In terms of other markets, across the board, oil's making a slight attempt higher. Already spoken about bond yields, but oil making a slight attempt higher. Nothing really too much to see there. I'm not sure why that chart has changed. Normally I have gold on that, but gold had a solid upside yesterday in yesterday's US session. As we headed into yesterday's US session, have had a bit of a pullback and probably looks primed for another movement higher as expectations for hikes are not ramping up. Now you do have the Fed next week, which will play a benefit in the price of gold. The Fed have suggested they are going to hike interest rates another 2 times, and that seems a unanimous decision by market. So I wouldn't say that's a clear trend established upward in the terms of gold. It's maybe a little bit of a credibility test once we get around to the Fed next week. If they do reaffirm their stance, we are going to see 2 further interest rate hikes. That should be another reason for gold to sell off again. But for now, positivity in the price of gold off the back of interest rate hikes being priced out, or expectations for no interest rate hikes being priced in, whatever terminology you want to use. That is all in all a positive development for the price of gold. In terms of what we got out later on, nothing really too much over the course of the rest of the day. We've got some Eurozone inflation figures. They are final figures. We already have had the flash estimate, so any miss on consensus, any beat on consensus, probably not likely to impact too much. Markets will work off the flash figure, so I wouldn't pay too much attention to those Eurozone inflation figures at 10 a.m. Not even a high impact release on this calendar. You do some housing figures out of the US, which again some negative figures. Did have retail sales pushing lower, some negative figures which had helped US stocks pop higher, and some weak housing figures over the course of today, probably likely to cause the same reaction as we have alluded to in recent videos. But that's where we're at the moment. UK assets in focus this morning. Massive downside in sterling, massive upside in the FTSE, and massive upside in bonds. So that's probably the side of the fence you'd like to sit on. Definitely a bit of room to go in terms of downside on sterling. A lot of long positioning needed to be unwinded. That 126 level looks a decent target to the downside on the price of sterling.